So this stream is specifically focused on the yield curve inversion. It's going to affect you, your family, my family, and the whole global economy. The yield curve just inverted for the first time since 2006. And what that means is that the economy is about to go into a major recession.
I was saying that I was looking at the CNBC yield curve inversion, and it actually looks like it's going to be a big issue.
Let me show you really quick what this means. So what we have in a normal economic environment is a yield curve that looks like this. That over time, if you save money, maybe up to 10 years, the longer you save your money for, the more money you make. So this is interest rate, percent return, and this is time. This is a normal yield curve. You would expect that the more time you invest your money into a US Treasury bond, the more interest that you will yield. And that's typically true for the 90-day and the 2-year. The 90-day Treasury bill will pay much lower than the 10-year bond. The 2-year Treasury note will pay much lower than the 10-year bond. Now on Friday, everything changed when the yield curve inverted. The yield curve now looks something like this. Now that means that the 90-day is paying more than the 10-year. You can see it's just a fraction, but what that means is you actually make more money by investing for only 90 days in a US Treasury than if you put your money away for 10 years. And that's a really scary thought. What that means is that people in the stock market, major hedge fund managers, money managers around the world think that betting long term is not safe, and it's actually safer to bet short term. The big warning sign that we're waiting for is actually the 2-year. The 2-year is still trading lower than the 10-year, just by a bit. But as soon as the 2-year is paying more than the 10-year, then we have major problems. And we can expect to hear that the stock market will start to crash shortly after that. But the fact that the yield curve already inverted with the 90-day and the 10-year is a major warning sign. The 5-year and the 10-year already inverted about 6 months ago. So what we're going to see is the domino start to fall. The 5-year was paying more than the 10-year. Now the 90-day is paying more than the 10-year. And soon when the 2-year is paying more than the 10-year, that's when everything is going to fall apart. What we need to focus on is that the 90-day Treasury bill is worth more than the 10-year Treasury bond. And what that means specifically to investors is that you can invest your money in a Treasury bill for 90 days and get a 2.5% interest rate. And that's higher than if you invested your money for 10 years in a government bond. That makes no rational sense. And that's why it's such a huge deal that we need to uncover what this means. Because, all right, so there's a lot of people that are telling me that the economy can't crash. This time is different. We're going to see a yield curve invert for 40 days before there's any warning signs for real. And I want to say that's typical. That's called serial correlation. And I'll say this time and time again. Serial correlation is thinking that past performance leads to future performance. Serial correlation is thinking that the past performance of the stock market is leading to the future performance of the stock market. And so you have all of these doubters who are full of greed right now. They saw the stock market correct in September all the way down to December. It's a full 20% correction. And they've been going greedy gangbusters since January through now. And they say yield curve inversion, that doesn't matter. What they're going to do is they're going to keep investing full steam. Everyone's asking me, where should I invest my money now? I've got so much surplus of cash. Everyone's gainfully employed. Unemployment's at an all-time low. Consumer spending is through the roof. Savings is very, very low as well. And so people are taking any surplus cash they have and they're spending it either in the market or they're spending it on consumer goods. Now, as far as the yield curve goes, typically we see after the first yield curve inverts, then roughly 19 months later, you're going to get a recession. However, a lot of pundits will say that you need a 10 to 40 day continuous yield curve inversion of the 2-year Treasury note and the 10-year Treasury bond. That means that the 2-year Treasury note is going to go higher in interest rate, maybe 2.5%, maybe 3%, and the 10-year Treasury bond, is going to dip below that. And so what we'll see is when that yield curve inverts for a period of 10 or 40 days, then everyone's going to start to take it a little bit more seriously. But I'm telling you now to take it way more seriously than anyone is saying, because the business cycle has already been going on 12 years. Your typical business cycle is 7 years before a recession. And the big money, the hedge fund managers of the world, they know this. And they're ready to pull their profits out of the market right now. The public pumped it up since the last downturn, which was the slight correction that ended in December. And now the yield curve is warning us that the market is going to collapse. Now, after that explanation today, I really hope that you understand how important this yield curve inversion is. People across the world are going to be impacted by this. Millions of people are going to lose their jobs. Families are going to have to sell their stocks at the bottom of the stock market just to make their mortgage payments. Please, please don't be one of those people that waits till the recession happens and the economy collapses before they become liquid. Make sure you're in a position to have 3, 4, 5, 6 months of cash on hand to allow yourself not only to live comfortably if you lose your job, but if the stock market does collapse and buying opportunities come about for real estate or in the stock market for the S&P 500, you can move in that capital. You can move that liquidity into the bottom and actually take advantage of those discounts in the market.